MRG Metals has signed a memorandum of understanding with Tianjin Lanqi Materials to form a joint venture for its corridor sands projects in Mozambique. Joining me now to discuss the details of this partnership is MRG's chairman, Andrew van der Zwan. Hi, Andrew.
Hi, Carolyn. Thanks for inviting me on.
Our pleasure. Andrew, give us a quick introduction to your Mozambique projects and how this MOU came about.
We've been in Mozambique now for about 4 years. We acquired the project off an Australian company, Safala Resources, a few years ago. And the history of the Corridor Sands project, that's what we call it, goes back to Western Mining. Western Mining had access to this project in total, and they were looking at it as a flagship project. They were going to spend over $1 billion to develop in country, including smelter operations in Mozambique. And as we all know, Western Mining was taken over by BHP. And for BHP, it just didn't hit the radar as being big enough, even though for us it's a massive scale project. So we were fortunate enough to, as a small company, we were looking for a low-cost exploration play with a massive resource, and we grabbed hold of this project about 4 years ago. Subsequent to that, we've evolved and developed the project out to resource level, and we came out a number of years, 2 years ago, with our maiden resource estimate over 1.4 billion tonnes of high-grade mineral sands. And then we kept drilling out, and we've expanded. We know the resource is massive. It's probably over 5 billion tonnes. And we got to the stage where, as a small company, what do you do with such a massive resource? The market really wasn't rewarding us for the work we were doing. So we decided that it's time to do a scoping study. And we last year, we did a full scoping study on the northern part of the resource called Coco Masaba. And we came up with a $250 million US dollar or $260 million US dollar NPV for the project. And unfortunately for us, given that the investment required was $250 million US capex, I think the market said, well, how is a small company like MRG going to actually get 250 million? So we decided, we knew that that was a first pass and that we could improve the grade of the resource, improve what they call the valuable components within the resource. Heavy mineral sands is a little bit complex, but we have very high base grade. And what you want to do is you want to combine that with a combination of valuable heavy minerals sitting inside that base grade. So we've spent the last 6 to 8 months trying to upgrade that resource, and we've done that, but we haven't been able to put that money or put that information back into the scoping study at this point in time. But because of that work we've done and we've announced to the market, we've subsequently had a lot of interest from people looking to see whether they could get involved in us on this project. So that's been the exciting thing. Unfortunately for our shareholders, we haven't been able to communicate that because obviously, you know, the ASX is very strict on what you can say and what you can't say. But subsequent to all that work, we've had a number of parties talk to us, and we're proud and happy to announce that we've done an MOU, memorandum of understanding, with Tanjin Lanqi. And what we announced yesterday is really a game changer for us, and we're looking forward to working with Tianjin Lanqi to take what the work we've done and their understanding of the industry to drive this through to the joint venture.
Yeah, so what makes Tanjin Lanqi an attractive JV partner?
Well, there's no doubt Tanjin Lanqi is a small private company, but they have experience in heavy mineral sands. They're operating out of Vietnam at the moment, but they're really trying to emanate to copy what's happening in Mozambique at the moment. The market probably isn't aware, but there's a number of Chinese players in Mozambique at the moment. Mozambique is endowed heavily with heavy mineral sands, and the Chinese have massive smelter capacity in China, and the companies such as Great Wall, which is now transporting over 1 million tons of concentrate out of Mozambique. There's another company, Freestyle, in China, which is growing as well. And there's no doubt that Tanjin Lanqi is looking to copy that, and they see the opportunity to grow in Mozambique. And for them, MRG as a small company with a massive resource sort of fills that gap as to how they can build their resource over, or the resource access over time. And that's what they're looking for, is access to quality resource that can give them multi-year mine life. And obviously for us, we're looking for someone that can partner us and provide capital, because clearly the market doesn't recognize what we're doing. Now, part of that's our fault, but African development is difficult, and the market hasn't rewarded us in wanting to move the project from exploration to production. But now we've entered an MOU, and the terms of the MOU are really fantastic for us as shareholders, in that we're really going to be able to work with Lanqi to take this mine from where take the project from where it is now to mining with no expenditure from MRG. We're basically free carried through to production, and there's some hurdles along the way which are very important for us, because one of the things that we don't want to do is end up being tied up to a company that can't meet the size and breadth of this project. So we've put protection in the agreement such that we're looking for them to grow with us, but if they can't, then we have the right to continue to grow with others. So we'll be 100% committed to drive the joint venture through to production, but we've got to make sure we protect ourselves, that we've got over 100 years of mine life, probably 200-300 years of mine life potential in this resource. So the last thing we want to do is be captured and tied up. But having said that, we want to grow with our partner and hopefully be in a long-term life operation with them. And the key elements of the MOU for us are capture sort of some of those protections that we're looking for, but sort of highlight how we look to grow together to be cash flow, producing cash flows in a few years' time.
Okay, so run us through the due diligence process.
We've now been working with Tanjin. We've been working with other parties as well, and I think it's important for our shareholders to know that we've looked at different ways of structuring these deals. We've had some companies that have looked to join us from a capital expenditure point of view. We've had some companies look to take our product. We've had others who are interested in operating the mine on our behalf. But what we ended up looking for is a partner that could pull all those pieces together. And for us, it's exciting that we can now work with a partner who has the capacity to look at getting the capital to develop the project, is prepared to work with us in working on with the government to get mining approvals, then has the capacity to take the product offshore and sell the product and make a margin acceptable to us. And that putting all those pieces together has been very difficult. And Tanjin Lanqi provides us that partnership, and we're committed to work that together. But as I said, what we need to do is make sure that in that process that we can continue to grow independently if our joint venture partner can't meet the hurdles that we've put in there. And I think for our shareholders' point of view, the thing that's most pleasing is that once the joint venture is formed, there's an initial commitment to put $3 million into the joint venture trust, such that the joint venture can progress the development of the project to mining, whilst Tanjin's obviously pulling together the capital, the capex to develop the project. So it's a very low risk opportunity for us. It provides great upside for our shareholders. Yes, we've had to give away 75% of the project, but we have no exposure to expenditures. And really for MRG, our strength is really we've developed a low cost exploration model, and this joint venture, whilst we'll be 100% focused working with Tanjin to get this to mining, it allows us to use our strengths and continue at some of the other opportunities we've identified, some of which the market is aware of and some of which the market isn't aware of. But there are lots of opportunities in Africa that we're looking at, and this joint venture will allow us to do that. So getting back to your question on due diligence, we've put in 3 months in the agreement for due diligence, but we've already been working with Lanqi for probably the last 2 months and their technical team. What they want to do now is get on site. They want to understand that the things we've identified or told them are true in terms of infrastructure, access to personnel, water, energy, all of those issues. And we feel very confident that they'll get on the ground in the next couple of weeks, and all proceeding well. I would anticipate that the 3-month due diligence period is really at the maximum length that we'll require. I'm hoping to be in China sometime in August to look at formalising joint venture agreements.
Andrew, great talking with you. Thank you for your time today.
Thank you, Carolyn.